Two blokes, same age, both 63. Both worked hard their whole life, raised their kids, paid off the house. One of them gets to 63, retires, and starts drawing down his super. Every year, he pulls money out, watching that number get smaller. Lying awake at 2 a.m. wondering, will it run out before I do? The other bloke? He's sitting on his back veranda right now, sipping a cold one, getting a deposit every single fortnight straight into his account from his super. He's not touching the balance. The balance is working for him. What's the difference between those two blokes? One of them knows about this, and the other one is sitting in a balanced fund, paying fees he can't even see, watching his super slowly get eaten alive. Stay with me, because today Gramps is going to show you exactly how the second bloke does it, legally, inside your existing super, and why your fund manager would rather you never watched this video. Now, before we get into the good stuff, let me show you what's actually happening to most Aussie blokes right now in 2026. You've got a super balance, let's say $400,000, maybe $500,000. Could be a bit more, could be a bit less. And your fund has you sitting in something called a balanced option. Sounds safe, right? Balanced. Very reassuring word. Here's what balanced actually means for your wallet. The average actively managed balanced fund in Australia is charging you somewhere between 0.7% and 1.2% per year in fees. On a $500,000 balance, that's between $3,500 and $6,000 a year. Gone. Before you see a single dollar. Every single year. And what do you get for that? A portfolio that's half invested in international shares, government bonds, infrastructure projects, things that pay you little to no income. Meanwhile, right there on the ASX, there are companies throwing off dividend yields of 5%, 6%, even 7% when you gross up the franking credits. And here's the part that will make your blood boil. When you flip your super into what's called an account-based pension, which you can do from age 60, those dividends become completely tax-free. Not lower taxed, not concessionally taxed, tax-free. And then, on top of the dividend, the government sends you a separate check, a franking credit refund, because the company already paid 30% corporate tax on that profit before it got to you. They give it back to you in cash. Your bank manager didn't tell you that at your last appointment, did he? Right. Let's get into the mechanics. Plain English, no jargon. Your super sits in what's called the accumulation phase while you're working. The fund pays 15% tax on its earnings. But once you retire, or once you turn 60, you can shift your balance into an account-based pension. In pension phase, zero tax on investment earnings. Zero. Every dollar your super earns in dividends, the government takes nothing. And because you're paying zero tax when those dividends come with franking credits attached, the ATO owes you money, not the other way around. Let me show you a real example. Say you've moved $400,000 of your super into pension phase, invested into quality, fully franked ASX dividend shares, the kinds of companies that have been paying Australians income for decades. The ASX 200 is tracking a gross dividend yield of around 5.5% to 6% in 2026, once franking credits are grossed up. Here's what that looks like on $400,000. Cash dividends at 4.5%, that's $18,000 a year. Franking credit refund from the ATO, roughly $7,700 cash back. Total income received, around $25,700 a year. Tax paid, zero. That's $988 a fortnight landing in your account, without touching a single dollar of your capital. On $500,000, cash dividends, $22,500. Franking credit refund, around $9,600. Total, over $32,000 a year. Tax-free. That's over $1,200 a fortnight. Now compare that to a term deposit at your bank right now. Maybe 4.5%, and you'd pay income tax on every single dollar of that interest. The bank wins, you lose. Inside your super pension, you keep the lot. Here's why most blokes never see these numbers. They stay in the balanced fund their employer signed them up for when they were 32 years old. Nobody ever moved them. Nobody ever explained that the game changes completely once you're heading for the door. A balanced fund is designed for someone who's accumulating over 30 years. But you're not 32 anymore. You don't need 30 years of slow accumulation. You need reliable income starting now, and you need the tax system working for you instead of against you. Staying in a balanced fund in retirement isn't playing it safe. It's leaving money on the table every single fortnight and paying a fund manager for the privilege of doing so. Now, Gramps isn't here to give you specific financial advice, and I'll be straight about that. Talk to a decent advisor before you make any moves. But what I can give you is the questions you need to walk in with. Ask your fund or advisor these 5 questions. 1. Can I move my super into an account-based pension now, and what are the conditions? 2. What investment option am I currently in, and what are the total fees including indirect costs? 3. Does my fund offer a high dividend Australian share option or a franked income strategy? 4. How much of my portfolio is currently generating fully franked dividends? 5. What is my fund doing with the franking credits it receives on my behalf? If your fund manager stumbles on that last question, if they look at you blankly, then mate, you've got your answer about whether they're working for you or for themselves. I learned all of this the hard way. Sat in the wrong fund for too long. Didn't ask the right questions. You don't have to. If this is the first time someone's explained franking credits and the account-based pension to you in plain English, without trying to sell you something on the other side, then hit that subscribe button. Every week, Gramps is here, breaking down the stuff the banks and the government don't exactly shout from the rooftops. No jargon, no blue suits, no BS. Just one old bloke who figured out the rules and wants to make sure you don't learn them the hard way like I did. See you in the next one, mate. Finance that feels like family.